Okay, part 3, automated option trading. This is the shortest part of this full course on futures and options, and it is made just to give you an insight in the matter of systematic and automatic option trading, which, let me anticipate you, is very complicated for a series of reasons which we'll see. Lesson 15, systematic and automatic option trading. Here what you will learn, what makes systematic and automatic option trading very hard to reach, no matter what they say, and why you have to be very careful in using trading systems on options. A primary distinction must be made in the field of quantitative option trading, and it is the one reported in the title of this slide. Do we want to create a systematic or an automatic strategy? A strategy cannot be automated if it is not first made systematic, of course. A personal computer must in fact be able to mechanically apply certain rules against defined inputs. The systematic nature of the strategy is therefore the first step. In the option field, for example, one could define a strategy such as if during the last technical month, let's say for instance from the third Friday of a month to the third Friday of the next month, the market has risen by at least X%, then short sell a call on the next monthly expiry date of the options, 5 strike prices above the spot price. Once codified, this strategy can be tested on historical data, analyzed in relation to its performance parameters, and subsequently it can also be optimized. The next step, that is of its automation, involves different criticalities, starting from the need to put different platforms in communication among them with all the problems that may arise. It is then necessary to define specific criteria for choosing the instruments on which to operate, which strike, which expiry interval, criteria for checking prices, criteria for moving orders in the event of failure to execute, timing of the movements themselves. As you can see, there's a lot of work to do, and some of these problems are very serious. According to Robert Pardo, the father of systematic trading, Robert Pardo wrote one of the best books about systematic trading. It is called The Evaluation and the Optimization of Trading Strategy. A must read if you want to understand what it really means to do systematic trading. The formulation and evaluation of a trading strategy pass through 8 distinct phases. The formulation of the strategy, the translation of the rules in a language understandable for the personal computer, the preliminary test, the strategy optimization, the walk-forward analysis, real-time application, evaluation of real-time performances, and improving of the system. Speaking of option strategies, some of the above steps are much more complex than if you opt for simpler tools such as stocks or futures. Now we will analyze in detail all these phases, introducing the critical points generated by each of them in the automation of option strategies. First of all, macro groups of strategies. As in the world of trading systems on linear instruments such as stocks or futures, so also in the world of trading systems on the options, behind the formulation of a strategy there must be an operational idea, possibly a good idea, and pay attention, this is not as trivial as it may seem. A good idea means the idea is based on a logic deriving from observation and experience, not by using the computer to test all the possible combinations of all the parameters available, so to find for sure something that works on the paper. But there is a choice that must be made even farther than the formulation of the strategy. In fact, unlike any other tool, the options allow you to invest in much more complex macro strategies, directional, non-directional, strategies that exploit possible market inefficiencies, the arbitrages, and strategies that combine different tools, for example, shares plus call options, the covered call writing, a very popular strategy, which we will speak of when the time is right. And depending on the type of strategy chosen, different criticalities must be addressed. Now, we analyze them in a specific context of a call short selling strategy, just to give a concrete example, to put ourselves in a specific context. Formulation of the strategy. The choice of the sale of options is generally motivated by statistical considerations. If in fact the idea is to bring the open positions to maturity, the sale of options allow you to benefit from the time lapse on and the sale of volatility to the counterparty. Confident that in any case the underlying, at least in relatively short periods of time, should not move beyond a certain price range with a high probability. Remember, we always move in the field of probabilities. There are no certainties, unfortunately. The sales signal can be totally independent of any consideration of the underlying. For example, sell a call at the beginning of a technical month, regardless of any other reason, or linked to the underlying. For example, every time the market leaves an overbought phase, sell a call. An example, if you're using the stochastic oscillator, when the stochastic gets over 80, the stock is said to be overbought. Is it the moment right to sell or to put yourself in a non-directional strategy? I think the underlying will not go up, so I short sell a call. Remember the plus, minus, minus, plus, all the symbols seen in that table in one of the last lessons. So once again, is the stochastic in the overbought area a right moment for selling a call, or perhaps it is better to wait that the stochastic gets below 80 from an overbought situation to a normal situation? Maybe that could be the right moment to sell a call. So in this case, we could link the trading signal to the fact that the stochastic was above 80 and today it's below 80. In the second case, in this one, we need a tool capable of analyzing the underlying and then going to operate on a derivative instrument. If the goal is to make the strategy automatic, once you get an operational signal generated by an indicator that can possibly be optimized, is it better 80, is it better 75, is it better 90, and is it better to calculate the stochastic over a 15 days basis or a 20 days basis or a 15 days basis, who can tell? Then you need to go and place an order on the most suitable option to capture the benefit of a possible signal correctness. And here the first complications arise. The choice of the option is two-dimensional, since it is necessary to define not only the strike, but also the expiry. What is needed, therefore, for the automation of such a strategy beyond the coding of the analysis on the underlying, which should be done anyway, is the setting of a maturity and a strike according to precise, codifiable rules. As for the first one, a work range can be defined, since when the underlying comes out of an overbought zone, you can have options with different maturities in front. As for the second, we can reason both in terms of a percentage distance from the spot price, with all the roundings of the case, given that the strikes are well defined and not customizable, or in terms of a certain number of strikes away from the strike at the money. And therefore, you have to define which strike is at the money. Remember when we saw the dynamics of option prices, we were looking at the FTSE index options when the index was quoting 17,680 and options were listed every 500 points. In such a situation, how do you consider the ATM strike? 17,500 or 18,000? Once formulated, the strategy must be codified in a language understandable for a personal computer. If the tool used for the coding of the strategies has all the possible functions already set in it, everything becomes much simpler and more immediate, but still it is not easy. Preliminary test. Then the so-called preliminary test must be done, which essentially serves to obtain two results. The first is to check that the coded rules reflect those formulated, and this means that the personal computer does what it must do, when it must do it. The PC must wait for a signal on the underlying, Then go look for the option that reflects the set requirements and sell it. If this doesn't happen, there's some mistake somewhere. In order to assess that the platform does all this, it is essential, first of all, that it can produce a detailed database of the historical operation that could have been carried out according to the codified strategy, the price at which to enter the order and the type of order to be sent to the market generate other criticalities, which we will discuss later. And as part of the preliminary test, a sensitive problem is given by the time series of the options, which represent an important obstacle, intraday or end-of-day data. Verifying that the system does what it was designed for requires the availability of a simulator that has all the real market data of all the series of options listed at a given moment. In this context, a first consideration is regarding the cost of historical data. If the strategy is based on intraday entry criteria, it goes without saying that it is necessary to have an intraday database of options. But this involves several problems. First of all, the size of the database, which quickly becomes enormous. Just think that the only 8-year end-of-day data of the options written on the SPDR ETF on the S&P 500 index occupy almost 4 million rows. But also the reliability of the data, which at every moment should be compared with the price of the underlying to verify its consistency and compatibility. Furthermore, the cost of this data is really important. Let me go back to the problem of the reliability of the data. Think of not very liquid markets, such, for example, the options written on the FTSE MIB index. There are no trades that take place at any time. So if you record data, let's say every 5 minutes, and the price is always the same while the stock index is moving, you cannot every 5 minutes record the same data, because that price is not coherent with that of the index. But the problem is that if there are no trades, you cannot record data coherent with the underlying. And moreover, what if the market maker takes away his quotes for a while? It happens, especially on the Italian market. What do you record in that moment? The price of traders that appear in the book in that moment? Those data would not be coherent with all the other data previously recorded, referring to the market maker. The problem on end-of-day data is different. In this case, in fact, the databases are large but manageable. The historical data have more accessible cost, however not marginal, and at least on markets with a certain liquidity, they are reliable. The liquidity of the market is fundamental for the reliability of the tests. The Italian market, in fact, often whole series of options may not exchange any contract for several days. And even the options exchanged during the day may not exchange near to the close, effectively rendering the last price exchange in combination with the closing price of the underlying unusable, because there would be no compatibility between the two. This obviously applies if the operating setup depends on the performance of the underlying or of some price indicator. Much better, therefore, to have the bid-ask closing data rather than the closing price. But this complicates, once again, everything. On less liquid markets, there are complications even with the bid-ask data. In closing, prices could appear out of the market because in the absence of a market maker, some cunning operators hunt for short positions that must be closed at all costs for avoid margin call situations. In those situations, the bid-ask you find in the book is not coherent to the underlying. From an operational point of view, if the data collected are those of bid-ask, then a choice must be made on what price to consider for the operations. Is it better to use the midpoint or the ask when you buy and the bid when you sell? On the US market, we can also take the 75th percentile on purchases and the 25th percentile on sales. It means the quarter around to the bottom when you sell, the quarter around to the top when you buy. But on the Italian market, this is not the case. Even on the most liquid instruments, if you put yourself at the 75th percentile, you will never get execution. An important feature of backtesting programs is the possibility to analyze the result of tests in specific temporal sections. In this way, it is possible to verify if one's own strategies can work well or badly in any phase of the market, or rather only in some specific phases. Knowing that a strategy works better in periods of high volatility is quite different than knowing that the strategy works only in periods of high volatility. In the first case, the application of a volatility filter may improve the strategy without compromising its reliability. In the second, one runs the risk of ending up in overfitting, arbitrarily eliminating negative situations from the equity line in order to exalt only the positive aspects of the strategy. The next step in defining the trading strategy consists of optimizing the parameters. Once a promising strategy has been identified, it is necessary to work on indicators and filters that could improve performance. It is useful in this sense that the analysis and simulation platform can allow the user to save the strategies and make possible a direct comparison between the basic strategy and any subsequent changes and optimizations. In this way, it is possible to compare directly the evaluation metrics of each choice. It is also useful that the platform can filter operations based on considerations of classical technical analysis, trend analysis, strength, direction, volatility indicators, or on the basis of typical options parameters, the historical and implied volatility, the Greeks, the open interest, and something else. All this while always keeping an eye on the risk of over-optimization of the strategy, the infamous overfitting. You have to be very careful in this field. Walk-forward analysis and real-time trading, from tests to reality, because any backtest is just a simulation of what could have happened in the past. Who can tell that what happened in the past will keep working in the future? The walk-forward analysis involves the use of the codified and optimized strategy on data that has not been used in the optimization process. In other words, it is a simulation always based on historical data of what the strategy is able to do on data that it has never seen and that therefore were not used for the formulation of the strategy itself. What does this mean? Suppose you have 15 years of data. You could use 12 years for the backtesting, the formulation and the optimization of the trading strategies, and the last 3 in order to put them at work just in paper trading, not putting your real money in the plate. Okay? The transition to real operation then generates a multiplicity of problems. First of all, we must define at what prices the computer must position itself when the books are empty, or when there are very large bid-ask spreads. It happens. We must define the degree of freedom assigned in setting purchases on mid-prices with respect to the spreads, and with what modalities we can move prices according to how the market moves. Assume that in this moment the bid-ask spread is 0.50, 0.60. You put yourself at 0.55. Then the underlying change, the price of the underlying moves. You have to move yourself as well. So you have to code how to react to movements in the price of the underlying. The type of orders to send to the market is critical. Adopting limit price orders for an automatic strategies in a market such as options can mean having to code a long series of possible behaviors, including waiting times. You put the order to the market. If you are not executed, how much time do you wait before changing it? About this matter, some trading platforms have introduced lately a function that allows you to automatically put your price in on the midpoint of the bid-ask spread. I don't like this kind of function because it carries a very important risk. If the market maker spots you and understands that every time he moves, you instantaneously move as well, because the system you're using automatically recalculates the midpoint and changes the order. What could the market maker do at some time? If he understands that it is just you against him, he could move up the ask part of the bid ask in order to let you increase automatically your buying order. And when it happens that he enlarges the spread enough for you to get exactly where it was in the ask side in the beginning, then it will hit you. And in this way, he would have led you exactly where he wanted you to go. And the same applies, inverting all the reasonings, if you are selling an option. He could reduce the bid in order to make you automatically reduce the price of your short selling until you get exactly where he wants you to go, and then he hits you. Working with market orders, by the way, can have devastating effects on the performance of a trade, especially when the market on which you operate is not very liquid, or you are operating in moments of high volatility. Think of when macroeconomic data come into play. The criticalities that afflict the prices at which positions are opened also affect the prices at which positions are closed, at least from one's perspective, the stop loss. If in fact it is necessary to close a position, perhaps to move it to another strike price, the rolling over of the position, to avoid incurring heavy losses following an unfavorable movement of the underlying, again, it is necessary to find a reliable book on which to base the exit decision, or have a formula of correct evaluation of the price to be proposed in an empty book, which implies a continuous monitoring of the implied volatility during the day. Otherwise, no model can ever estimate a correct theoretical price. An automatic system that must operate in such a situation must be able to assess whether the price in the book makes sense or not. And if it does not find a price, it must be able to formulate one from scratch. And again, the problem of volatility monitoring arises. A particular complication is represented by the options that risk to expire in the money when the contract provides for the physical delivery of the underlying. The strategy must include the possibility of having to manage the positions in shares or futures originating from the exercise of options expired in the money. Alternatively, the strategy must provide for the closing at any cost of the in-the-money options close to the maturity, and this generates further problems, generally speaking, empty books, or in any case, amplified bid-ask spreads, all combined with the need to act quickly, devastating effects. In my personal experience, unless you are testing a strategy on stock index options, such as those written on the S&P 500, the German DAX, the Eurostoxx 50, or the Nasdaq, a manual backtesting of your strategies is highly recommended. And results must, however, be analyzed with great critical spirit, even on very liquid instruments. For now, that's all, because I don't want to go too much into details, but let me say once again that the systematic and moreover automatic option trading is very complicated. You have to be very careful in doing it. You have to be very critical in evaluating the results. You have to give a special eye to the quality of data. You absolutely have to use real data and not simulated one. Otherwise, you would work on data that are most of the time not coherent with the market. So once again, please be very careful in this field. Thank you for your attention.